And now think about having a completely unguarded financial system that could just be corrupted and invaded by sovereign entities who want to see the United States fall. Think of what they could do to our financial system. Now, we need to rip the Federal Reserve down to its studs. It needs to be completely re-engineered. It needs to be made independent and apolitical once again. And I would venture to say, I think Jay Powell's a man on a mission to help see that vision through.
In this video, Danielle DiMartino Booth, a former member of the Federal Reserve, delves into the critical issues surrounding the Fed's actions and their consequences on the economy. From credit easing to quantitative easing and mortgage-backed securities, Danielle uncovers the hidden truths and long-term effects on mobility and economic health. She also discusses the role of central banks in stabilizing financial systems and the need for re-engineering and independence within the Federal Reserve. Join us for an eye-opening discussion that challenges prevailing notions about monetary policies and their impact on our lives.
If we cross this Rubicon into credit easing, which is specifically in violation of the Federal Reserve Act of 1913, we could end up impairing mobility. And somewhere down the pipeline, if we're buying all these mortgage-backed securities as part of this big quantitative easing, large-scale asset purchase program, you could impair mobility to the detriment of the long-term health of the economy. I lost that debate, obviously, because we kept going with QE and MBS. And then in the second iteration of it, after the pandemic hit, of course, the Fed ended up buying a third of the mortgage-backed securities market. And now everything's come home to roost that we were concerned about. In data back to 1948, we have never seen mobility be this impaired. Nobody wants to get rid of a 2.5% 30-year fixed mortgage. And that is the end result of the Fed buying a third of the market, was they artificially repressed mortgage rates. These are the kinds of experiences that I had at the Federal Reserve, which were just fascinating. And we're seeing play out today. When Jerome Powell was first on the board, I was very of the same mind that he was, that it would be very difficult to extricate from blowing up the balance sheet when the time came, and that you could cause serious problems and, the entire credit market. These things are actually coming to fruition. So it was a fascinating almost decade that I spent at the Fed. It's even more fascinating to watch the debates get settled in the marketplace, which is what's happening now. So I am, for the record, I am not the creature from Jekyll Island. I
did read that.
I think that book introduced some non-truths into kind of the thinking about the Federal Reserve. I was actually just filming on Jekyll Island and learned a lot more about what happened at the time. And we forget that it was as simple as JP Morgan himself saying, "I am fallible, I will die," after the panic of 1907. We're no longer an emerging market. We're no longer a developing market. We're a developed country, and it's time for us to have a central bank that in times of serious financial instability, there is an arbiter that can come in and stabilize the system. And that's exactly what we needed when we woke up and Lehman Brothers blew up and systemic risk had been ignited. And the Fed did have to step in. Don't get me wrong. I wrote a whole book about this. It was a situation they created in conjunction with everybody else who fed the housing market bubble from the credit rating agencies who looked the other way when subprime wasn't really even any prime. But there were many players who were responsible, and the Federal Reserve was certainly complicit. But at a time when systemic risk is unleashed worldwide, you have to have adults in the room who can come in and stabilize the financial system in the absence of somebody as strong as JP Morgan himself, who corralled a bunch of bankers into his parlor room in 1907 and said, "Nobody leave until we come up with a solution." You could do that back then. And people always say, "But can't we just live without the Federal Reserve?" And I'm like, well, we could, but think about what the Chinese have done with U.S. intellectual property. Think about that for a minute. And now think about having a completely unguarded financial system that could just be corrupted and invaded by sovereign entities who want to see the United States fall. Think of what they could do to our financial system. Now, We need to rip the Federal Reserve down to its studs. Studs. It needs to be completely re-engineered. It needs to be made independent and apolitical once again. And I would venture to say, I think Jay Powell's a man on a mission to help see that vision through. I think the modern day error, if you will, was when Congress created the dual mandate in the late 1970s. So maximizing employment necessarily, by economic definition, conflicts with minimizing inflation. You simply cannot pursue the same two mandates at once and not kill one or the other. We're watching today as we speak. We have with fresh data out on initial jobless claims, we have 90% of the U.S. population living in a state with rising ranks of continuing unemployment beneficiaries, 3 months running. So we're watching live recession set in. And yet we've got Jay Powell saying, I understand we're going to have to hurt the labor market, but it's going to be better in the long term if we get inflation back down. So he's telling you we can't do both. We can't do both. When it was too low for too long, it was so that they could bring every last person off the sidelines into the labor market. What did that do? Well, it inflamed inflation when that got going, when the fiscal authorities started throwing money into the hands of taxpayers, directly depositing it, which is why we had inflation like we did. People are always like, why couldn't the Fed ignite inflation alone with quantitative easing? All of those years that Bernanke could not hit a 2% inflation target. If you gave him a bazooka, he couldn't hit that inflation target. You had the banking system as an intermediary. You can lead a horse to drink. You cannot make that horse drink the water. And that's what QE failed to do in terms of trying to bring inflation up to a 2% target. It's that the easing got stuck in the financial system. Inflation was in asset prices, but you bring Uncle Sam in and you bypass the banking system. You give trillions of dollars directly to individuals with the highest propensity to spend. Boom, you got inflation overnight. Did the Fed play a part? Yes, they monetized every last penny. But again, the combination of the two is what made the Federal Reserve as powerful as it's been in conjunction with the fiscal authorities. They have to be together in order to create this crazy inflation. We have to think of the era in which the dual mandate was introduced. The Carter administration felt that it could not get employment under control. It was just a runaway train. They felt like they needed extra help in trying to get the unemployment rate down. But giving the Fed the authority to take that place was not the right route to take. In times of recession, fiscal authorities do step in, but in a capitalist nation, it is the job of the private sector to maximize employment. And having the Fed step in to that role has corrupted the institution. But again, this was an act of Congress. And Congress tells the Federal Reserve Board in Washington, D.C., whose email addresses end in .gov. It is a full-blown federal government agency where the permanent voters live. It's their job to do as Congress tells them to do. You unwind it by being Jay Powell and by holding together your committee. We have become accustomed to, and too low for too long. It's how we are. The Fed's got your back. Don't fight the Fed. Well, right now, he has managed to create a higher for longer environment that most market participants continue to deny exists. We had a district president come out and say that there won't be any rate cuts until 2025. And the market's like, that's impossible. He'll break the market. He'll break the Fed put. Well, if you break the Fed put, people forget in 2018, when Powell first attempted to normalize monetary policy, shrink the balance sheet at the same time as raising interest rates, he got all the way to 2.5% on the Fed funds rate and had to do a huge U-turn. Right now, he's got more than 2.5 percentage points of easing in the chamber. He's got 300 basis points of easing in the chamber to stop at 2%. You said it's a broken tool. You know what? Let's throw it out of the toolbox. Zero interest rate policy failed. Let's get rid of it. But he's got enough latitude right now to lower rates as much as he did last time and stop at 2%. Get rid of zero interest rate policy, ZIRP, as we called it. And when he was asked at his most recent press conference, if you're pausing, if you're not going to raise interest rates, does that mean necessarily that we're going to start to stop quantitative tightening, stop shrinking the Fed's balance sheet? And he was like, nope, didn't mean to imply that. Next question. He moved on very quickly. And he's trying to tell us in his way, QE failed. We don't need to talk about when we might or might not do QE again because we need to remove it from the toolbox. It's a failed tool. It's a failed experiment.
Wow.
So if he accomplishes these two things, you start to wake up in the morning, you pull up your Bloomberg headlines and it says, right now, buzzards are moving in and buying private companies for 39 cents on the dollar. That's what higher for longer looks like. It looks like actual price discovery.